Hello, everyone. My name is Guy from the Patrimonium Group. We thought, following the certain elements and events from the market this week, that would be kind of fun to give our take a little bit on the emotions about the market. So we want to give you the financial market update a little bit from our perspective, as it is always. So obviously, Monday was an interesting day about the Japanese market that went down over 12%. And without going into all the details of it, one of the things that happened is that the yen was pretty strong compared to the other currencies around the world, especially the US dollar. And based on that, where all central banks wanted to cut rates coming in the fall, the yen did actually the opposite by increasing their rates. So obviously, it kind of brought some emotion into the market, some discrepancy about what was going on. So, and as we know, emotions can take us pretty low or pretty high, but the market as well. So the Japanese market went down 12%. In addition, the economy or the numbers about unemployment in the U.S. Went up from 4.3 to 4.1 to 4.3%. So just sending to the world, to the markets, that instability. And anytime that there's news that create instability, it creates a lot of emotions. So in addition to the Japanese news, Japanese market on Monday, we've been talking about obviously the election for the past well, many months. And anytime that there's a change, such as a Trump versus Biden, now Biden getting out of the running and being replaced by Kamala Harris, it again creates some instability. Now, if we look at the surveys, Biden was way down, and now Harris is very close to Trump in terms of the chance of winning. But this said, it created some instability, created some emotions, and as we know, the market, when we bring it down to simplicity, it's a lot about emotions. And obviously, we are currently talking or bringing back the subject of recession. We've been talking about it for the past year and a half. Obviously, when we have an inverted yield curve, we should expect a recession coming forward. But the unemployment was so low that that was the element that made us not sure about where we were heading. So was it going to be a slowdown? Is it going to be a recession? But should we fear a recession? And we're going to try to bring a slide a little bit later on just to find out what, on average, what happens to the market while we are in a recession. So obviously, all these elements, what that brought volatility. And volatility, we have an index that we can measure it. And the measure of the volatility comes from the VIX. So without going into the detail, we even call it the fear index. So what happened Monday, the VIX went way up. It finished the day at 38.6, but it went as high as 65 in terms of number to finally, at the end of the following day, Tuesday, brought it down to about 25. Just to put things in perspective, as you can see here, there's a 200-day moving average. So it was way high based on that news from the Japanese market, but around the world where the markets have gone down quite a bit. But when we look at the history of the VIX, basically, as we go above 20, as portfolio managers, we have a tendency to really be on the lookout for opportunities. Why? Because people have a tendency to fear the market at that time, and it brings back down the indexes or any stocks that are on the market. So we're looking at opportunities to see stocks at discounted rate and maybe opportunities to buy. So that's what we're looking for. But this index, called the fear factor, just gives you an idea of how much the emotion we can bring into the market. So it was pretty high on Monday, brought it back, and it can be extremely volatile. So you'll often hear me talk about not having risk in a portfolio, but having more volatility. And this is an element or an index that we're looking a lot whenever there's variability into the markets. So based on this, I often get asked the questions like, should we get out of the market? I'll show you a slide where it'll I'll show you why we don't get out of the market. But on a daily basis, and it's been pretty quiet for the past year and a half, but on a daily basis, having plus or minus 2% fluctuation is pretty regularly, as you can see on this slide right here. So it can go as high as plus 10 on a day, or minus 12 on a day, like it did in the pandemic. But if we look back over the years, in 2008 recession and all other recessions, as we fear a recession, the volatility increases. So there some plus or minus 2, plus or minus 3% are pretty common. And as a matter of fact, I saw a slide or a statistics last year where plus or minus 2% on a daily basis occurs approximately 30% of the time throughout a year. So that's a lot, and you can see it that there's been, many volatile day, and that's why we try to not look on a daily basis or get the emotions into our way. So as you can see here, for the past year or so, we had not had, prior to Monday, basically any plus or minus 2% fluctuation in a day. So based on this, we know that as individuals, we are emotional. What we try to do as portfolio manager is we try to eliminate those emotions, which is sometimes difficult even for us, but we try to eliminate these emotions, because as often as the emotion kicks in, what happens then is that we have a tendency to, not portfolio manager, but people individually, to want to buy stocks when everything, or the markets indexes, when everything goes well, and they want to sell when everything goes bad. Whereas it's exactly the opposite. Over the past 20 years, it's always proven right. So that's when things are not going well, that the opportunities are. And long term, to make good returns, you need to buy low and sell high. So that's really what I wanted to show, because over the past 20 years, I've used this slide year in and year out, because as human beings, we are emotional, and us, through our process, what we want to do is we want to bring the rational portion of our brain, our prefrontal cortex. So based on this, if we look at the history, you know that it's twice as painful when the markets go down, and when the markets go down, those are the green bars here. But we know that on average, it's much longer, the bull market, than they are the bear market. Even though the bear market are twice as painful as they are, we have a tendency to forget that if we look over the long term and not the short term, and we have a tendency as individuals to look short term, that's what we call the recency bias, which we will talk about in our next webinar. We got to be careful to not get too short term, even when we're 60 or 70 years old, because as we plan for our future, we always look at the 10, 20, or even 30 years, depending on our age. So on another slide, we often hear lately about, obviously, the elections coming in, and I get asked, so what do you think if Trump comes in, or a Republican or a Democrat comes in? What are your thoughts about the market? Well, I thought this was a perfect slide to show, to kind of try to, again, take the emotions out. As we look at the curve here, we know from 1900s that the tendency of this is the S&P 500 for the past 125 years. What it does, it goes up. However, there are lots of fluctuation. But one interesting thing that I thought was to show you here, but I'll make a tweak out of this slides, is that overall, while it was a Democrat president, the annualized return of this S&P 500 is over 12%, whereas when it's a Republican, it's 7.8%. And the reason why I like to show that slide is that we have a tendency to think that if the Republican comes in, they're going to cut rates, cut taxes, and the market has a tendency to go well. Now, my take on this, obviously, economic cycles are not just one term. Now, obviously, if it's a two-term president, it's over 8 years. As we know, a term is 4 years. But the cycle intertwine between each president. So as one president or one party decides to do something, they'll have a positive or negative repercussion on the other party coming in. So, but all in all, what I wanted to say is that often when I get asked, what do you think is going to happen? Since we are pretty bad at predicting in the future as human beings, I try to stay away from it because I really don't know. But I like this slide just saying if we look at the long term, either way, we should be fine. But if we look short term, then we have a tendency based on the numbers to see that if it's a Democrat, that the rates are better, the annualized return are better. So just wanted to post that one because I thought it was an interesting one. I don't think it's as clear cut as saying that one party versus the other creates more return for the investors. It was basically just to say that over the long term, either one will have politics that will change and affect individuals, but in the long term, the tendency is moving upward. Then, should we fear recessions? Because now it's back in a little bit, especially after Monday's news. So without going throughout all the recessions, obviously it's never fun. And like I mentioned, because of our loss aversion bias, it's very painful when things go down. And since we have a tendency to look more short term, obviously it affects our decision-making process. We try not to look at it that way. We'll try to look at, okay, so what's the average 12 months prior to a recession, and how long does the recession last? And we know on average at about 11 months, less than a year, and then the next 12 months after. So overall, prior to a recession, we have a tendency to get returns at about 7%. And this is a balanced portfolio of 60 stocks and 40% fixed income. But what was interesting, and I know it fluctuates, and I know it's just an average, but in average, the lowest it's been minus 16% during a recession, but the highest return has been in 1980s at 9%. So all this said, on average, our portfolio doesn't get affected so much if we are well diversified and if we have a fixed portion in our portfolio. And after the 12 months, on average, it's a little bit higher at 11%. And all in all, over the 3-year period, it's generally about 18% return that we have, which is a good protection of capital. And that's what we try to do ultimately in wealth management, to create a decent return in order for you to achieve your financial goals, that it be for retirement or for whatever other reasons. Then, next slide. I get asked, when things are not going very well, why don't we go cash? I've shown many different ways this slide, but this one is the most recent one over the past 30 years. As of June of this year, 2024. Interesting enough, for a 30-year period, invested in the S&P 500. Now, granted, this is not a fair a slide in a sense that very few people in their lifetime have been invested 100% in the US market, especially as Canadian investors. But it's just to prove a point here that obviously we always talk about the US market being, or the economy, the US economy being the economy around the world. As the US goes, the rest of the world goes. And I still think to this day that it's true. But let's say that in 1994, you would have invested $100,000 without ever looking at your portfolio. 30 years later, it would have been over $2 million. The next part here, if you were to miss one day, the best day out of the past 30 years, the portfolio would have gone down from 2.1 million to 1.9 million. Still very good at 1.9 million, but it's just one best day out of the 30 years. And then if we missed after that, the 10 best days and the 15 days and then the 25 and 50 days. But if you go down to 100 days, you missed the best 2 days or the best 3 days out of the past 30 years, you would have a negative return. And considerable amount below $100,000. And that's why we always say over the long term, we want to stay invested. We don't want to time the market. I don't think anybody is good enough to be able to time the market. And I like this slide because it shows to me that if we have a well-diversified, a well-built portfolio, we should be able to sleep good at night. And this one is really important in terms of the variable portion, the stock portion of your portfolio, to just stay fully invested. Based on this, all the emotions, we try to put it away, and that's why we look at, sorry, I just see the little spelling mistake here, monetary policy. What we do is we really want to bring the rational part of it in our process. So yes, we could debate that the central banks are too slow to act, either raising rates or cutting rates. But to this day, I mean, that gives us a solid foundation to try to look ahead and see what's going to happen. And as of yesterday, the probability of rate cuts across all central banks in Canada, US, and Europe, it's 100% probability of cuts in September. What's interesting here is that obviously as rates are cut, what happens to fixed income, I'll show you on the next page, but the amount of cuts that's expected for the next 3 months in Canada are 2 rate cuts. 2 rate cuts presenting 25 basis points, about 50 basis points. Now, the Fed, which was just about a month ago, was not that much in terms of rate cuts, but now they've really mentioned that they're expecting to cut rates in September, and we're expecting 3 rate cuts of 25 basis points. Now, those are probabilities. That it will happen or not, we don't know, but the tendency is that there will be rate cuts. So I'm very comfortable in saying that there should be cuts coming sooner than later, and maybe a little bit harsher than we could be surprised. Same thing happens in Europe with 2 rate cuts. So what does that do when central banks, even though they're more on the curve of the short-term curve for the interest rate of 0 to 2 years, it has an impact on the bond portfolio of our bond portion of our portfolio. So that's why the diversification should be pretty good, and we should be well positioned moving forward for the next 6 months. So what happens if there are no rate cuts, which is the line here at 0 basis points, we should expect on a balanced portfolio to have about 4% return, 4.1% return on our fixed portion, which will protect our capital. But if it does happen where there's R50 or 75 basis points, we should expect a higher return, because as rates go down, bond values go up. So we should be expecting decent return. And if there is a slowdown or recession, that portion now should be able to do the job of protecting our capital for a portion of it. So we expect rate cuts from the central bank. That should be interesting, and our fixed portion of our portfolio should do pretty well during that period. So where does that put us? That put us into the our strategic asset allocation for our balanced portfolio. Same concept is for those that are a little bit more growth oriented or those that are more income oriented. But basically, as you can see, we have very little cash in the portfolio. We are a little bit overweight into fixed income. And the reason why we're a little bit overweight in fixed income is just for the reason that we're expecting to have rate cuts, as rate cuts that I've just shown you should increase our portion of our fixed income in our portfolio. We're pretty neutral on Canada. The US we're a little bit overweight, and a little bit overweight into the foreign equity, so which is everything that's non-North America. And why we're positioned that way is that the emerging market has been in a recession, according to us, for the past couple of years. It was a pretty cheap market, so we wanted to start adding up a little bit that portion of the world, as well as Europe, which for the past 10 years have not done as well. So we're expecting that portion to be a good diversification in our portfolio. And obviously the other portion, those are alternative assets, which are non-correlated to the rest of the portfolio. And by doing this, we again protect the capital and hopefully will give you a decent return. So all in all, lots of volatility. It's starting to calm down a little bit, but expect volatility. Volatility is not necessarily negative. It is on a human being a little bit more of nerve-wracking when we listen to the news, but the news have to say something every day. We try to look at it into the long term. We try to really rationally take all the elements of the economy, put it into your asset allocation, give you a decent return, and hopefully we can diminish the anxiety or the emotional that you have in your portfolio. All this said, just wanted to say thank you. Have a great rest of the summer. Our next webinar will be, or capsules will be, in September. And we will be talking about recency bias. What does it do into our portfolio, and how does it affect our portfolio? So all this, have a good time. We are always available. If you need to contact us, please contact us. You have our email address. Mine personally is guy.degno@bnc.ca, guy.degno@bnc.ca. So please do not hesitate. We're there for you. Looking forward and talking with you soon. Make it a great day. Bye.